Hello and welcome to the Monday Dividend Cafe. I am your host, David Bahnsen. I am sitting in our studio in our beautiful Newport Beach headquarters, where I came back over the weekend after being in where have I been over the last week and a half? New York City, Houston, Nashville, Washington, D.C., New York again, and now here back in Southern California for a few days before returning to New York in a few more days. And so there is a lot that I want to go through today. It's not an excessively busy Monday, but it's not a dead Monday either. There's a little bit more of a focus today in some of the public policy stuff. Let's go through the market recap. But before I get there, as always, I just want to remind everyone our main Dividend Cafe that comes out every single Friday. Uh, I want to point you to this last Friday's Dividend Cafe that was a kind of special issue on the Fed. A lot of questions are out there right now about our projections on what the Fed's doing, what we believe it means in terms of what the Fed has already done, how we're thinking about it in terms of investment policy. And I think I answered all of those things in one sort of omnibus Fed Dividend Cafe on Friday. So do check that out. The market had opened down about 300 points today on the Dow. Futures were down last night as I was going to bed. They were down this morning when I was up. And then the market kind of spent almost the whole day just sort of recovering, and ultimately the Dow closed up 66 points. The S&P was up 0.4%. The Nasdaq was up 0.7%. Lots of names were down. I didn't look at the advanced decline line today. I imagine when I see it in the morning, though, it'll be negative on the day. I don't think there was great breadth on the day, but I think a couple names pulled the market in positive territory. It's odd, though. I talk so much about technology as a sector, and then its cousin is communication services. That communication services, when I first entered the business, didn't exist. It was sort of part of the technology sector, and they kind of did a spin-off sector, and it has maintained adjacents. Today is one of these rare days. I think I've seen it maybe twice, other times total. I mean, I'm talking about over many, many years of looking at this every single day of my life. The technology was the top performing sector today. It was up big, 1.75%. That was largely from a big move in Nvidia. And communication services was the worst performing sector today, down 1%. Generally, and this is true today as well, there is actually just sort of an outlier of a given large name pulling one up and another large name pulling one down. That's what happened today as well, but just thought I'd point out because of the novelty of it. Um, so just again, speaking of novelty, I've known because I've said it, so many times I lost count over the years, that back in March of 2009, when the market hit its bottom in the post financial crisis violence in markets, the S&P 500's low was 666. And there's sort of a lot of reasons why that number is kind of easy to remember for some folks. And Peter Bookvar pointed out that on Friday, the S&P 500 hit 6666. So there you go, a rather fun numerical encapsulation of what has been a post-financial crisis rally for the ages. I do think it's interesting to see that earnings growth right now for what is expected in small cap is significantly bigger going into 2026 than large cap. Now, that's not because the earnings picture is bad for large cap. It's very good. And it's also not because the earnings picture is great for small cap. It's, again, a reference to what we call base effect. Large cap year over year earnings growth next year are coming off of what has been really good earnings growth this year, the year before, year before. Small cap has had, very, very tumultuous times. So a percentage growth year over year off of a low base, is going to have a different mathematical result. But the point is that there is, for the first time in a while, a bit of optimism about some fundamental improvement in the earnings growth environment of small cap, some of which, not all, some of which is related to the lower interest rate environment and lower interest rate expectations that helps small cap more than large cap in terms of cost of capital, much more variable borrowing in small companies and more fixed borrowing in large. 10-year bond yield today closed at 4.15%, kind of flat. I think it was up 1 basis point in the 10-year yield. The consumer staples sector, its earnings ratio to the S&P 500 is now the lowest it has been since March of 2000. So, we don't think of these things as tradable bottoms, but we do think of them as fundamentally interesting and pointing to, again, regardless of timing, just a entry point that we certainly feel really excited about. I would also point out Mag 7 kind of making new highs late last week, and then some of the names were up today, some were not. At the same time, the Russell 2000, the small cap index, is making new highs. That has not been the trend for several years. You've really had big weakness in the Russell and big strength in Mag 7. And now you see both really doing well at once. That is kind of, I think, getting down to the heart of the matter of right now, there's a more indiscriminate risk on. And investors tend to love that. I tend to not love it, but I also tend to know it doesn't last as long as people wish it would. And speaking of things that aren't lasting, the highest performing factors as of late have been momentum and beta. The more beta, the better. And that can last until it doesn't. In terms of, I mentioned public policy, there was a little hubbub, and I suspect it was part of the downturn in futures last night and into the morning about the White House's announcement over the weekend of a new $100,000 fee for H-1B visas. Now, then part of the recovery may be that the more the White House elaborated, the less problematic it looked and much softer it looked than what they had originally kind of flexed. This is a program whereby workers from overseas are able to get a work permit in the U.S. And is intended to recruit top talent from overseas. The administration did clarify this is only going to apply to new hires, not people already in the H-1B visa program. It will not be applied to renewals for those already in the program. They won't have to start paying it in the future. They're kind of grandfathered. And another announcement that came today, too, is that they're going to have various exemptions, including apparently the talk from the White House is that doctors are going to be exempted entirely. And then the statute itself, the order itself specifically says that anybody can be exempted at the discretion of the president. So it's a big announcement and has a possibility of impacting lower end wage job growth, but I don't think that it proved to be quite as dramatic as had been threatened over the weekend. Speaking of other public policy announcements out of the White House, I talked about this on Fox Business on Friday, the framework of a deal being announced with the White House and China about TikTok. And it's a complicated deal. I don't really want to get into it at great length right now. But essentially what we're being told is that the U.S. will not be an equity stakeholder in it, but will have a board seat, the federal government. China will maintain 20%, ByteDance, the Chinese-based company, will maintain a 20% ownership in the U.S. operations of TikTok, but that Oracle will end up being one of the lead investors and sort of in charge of the data and security provider, overseeing the source code of the app, and then they will retrain the algorithm and so forth. So it's not exactly what people wanted. It's I don't know what to say. I'm just reporting the news. But that is a more interesting announcement in the sense that, first of all, there was a lot of constitutional and legal things that ran around it getting there. But then it does speak to, again, a pretty muscular view of intervention in business from the administration. And I would say not exactly solving what they originally intended, which was some sort of decoupling from China. This really represents kind of a merger. I would imagine that this deal will end up getting critiqued from a number of different sides. And then now on the policy side, there's a lot of talk that the government's going to shut down in a week. I think any of you have listened to or read Dividend Cafe for any period of time know how I feel about this. melodrama around shutdown, that they never really happen, and when they do, they never last, and whether they do or don't, and whether they last or don't, they don't have a market impact. That it is just a real embarrassing part of American governmental life that we go through this charade. The only thing I would say that's maybe a little different on this is it is the Republicans now saying let's just sign as is stipulation to fund, and it's the Democrats saying no, we want concessions before we go to a just full blown extension. So in other words, the Democrats, if they want to shut down, would be the ones doing it. And I on all sides of this stuff, the grandstanding and using it as a campaign thing, it's tricky politically, but I don't think it has a market impact, so I won't spend a lot of time on it. The annualized amount, which is not the same as what has been collected so far, but what is anticipated to be collected from new tariffs on an annual basis, is over $350 billion right now. And that could get close to 400. I do not expect at this point it will get over 400 billion. And I just want to point out that some continue to refer to this as revenue United States Treasury, which is certainly true. It is revenue to the Treasury, the same way the income taxes you and I pay is revenue to the Treasury and an expense to us. That's what the very nature of double entry accounting is. One person's credit is another person's debit. In this case, the credit to Treasury of tariff revenue is a debit to American businesses. And the issue is really what the impact of that $350 to $400 billion cost to American business will be. So that is not a 1 week, 1 month type story, as I've covered quite a bit over the last several months. Moving just real quickly to housing. I read a report this morning from First Trust, which is a firm whose research I read pretty regularly. And they talked about an 8.4% decline in rents in Q2, and that being the largest drop on record. And I hadn't read that anywhere, and I looked and looked trying to find other sources or whatnot. And sure enough, what they're referring to is a 2.1% quarter over quarter drop in the BLS's new tenant rent index. So it's a more narrow subtext, but nevertheless, it is true. If you take 2.1 and multiply it by 4, then you get 8.4, but it's an awkward way to say it. This is not a data point we're used to annualizing. And the 2.1, the idea that it would be sequentially followed by another 2.1, another 2.1, that's not necessarily. I'm one who's believed for some time that rent inflation is way overstated, but not even I believe it's anywhere near 8% deflation. Suffice it to say, though, that this is a point that some calling for dovishness from the Fed, including the new Fed governor, Steve Myron, whose speech at the Economic Club in New York I heard today, is using this fact of expected softening in the way that we measure inflation out of shelter, particularly rents, to in their modeling push their expected inflation rate and necessary Fed funds rate lower. So it's still, even if I think they're getting to their data point in a weird way, the directional point they're making, I happen to agree with. I laughed on Friday. The headlines coming across: Japanese bond yields hit highest level since 2008. And then what they're referring to is that their 10-year bond yield is now at 1.6%. So yes, that is the highest in a while, as it sits at 1.6. Oil was pretty much flat today, still just barely above $62 a barrel. Bad week for midstream last week. Actually, the Canadians were all up. The US and MLPs were down, so kind of a mixed story there. One person wrote in asking about my Friday Dividend Cafe on the Fed, if I thought part of what was at play was the Fed's need to keep borrowing cheaper, rates cheaper for the borrowing that the federal government does. And it is an issue that I've talked about a ton over the years, and particularly the way in which the monetary and fiscal accord has strengthened over the years, and not, I think, in a good way, and where that ties into the Japanification narrative. It is something I should have addressed in Dividend Cafe Friday, but I don't think it's related though to what the Fed's doing right now or what they're going to do next quarter or the kind of more short-term relevant issues around their motives in the administration of monetary policy. I think this more speaks to a structural issue of obviously very significant excessive government debt that does need the Fed to help be an accomplice in lowering that cost. I don't think that's a decision they're making right now, but I think in terms of the secular cycle that we're in, that there's no question to me that the monetary and fiscal accord is still on. So I appreciate Jeff writing in that question, and I think it is very true, and it's something I've said quite a bit already. I probably should have restated it and kind of reiterated that rationale in Friday's Dividend Cafe. I will go ahead and leave it there. We do get, if they go ahead and release it, which there's talk they may not, the August PCE data, which is supposed to come this week in terms of the newest inflation reading. And other than that, we are definitely in that lull, waiting for the Q3 to end and get into earnings season here in a few weeks. So reach out with any questions you have. And we will continue doing what we do here at the Bahnsen Group, and I'll continue trying to bring you good insights in the Dividend Cafe as often as we can. Thanks, as always, for watching, listening, and reading the Dividend Cafe.